economists define capital is this is financial capital who was talking about. There another definition of capital would be plants and machineries and factories that are produced by men to produce more goods and services. So we have resources, the way economists define resources, the land, labor. Capital is one resource and the entrepreneurial ability. So the capital here is the tractor, a factory, machinery is a tool, an implement, man-made, human-made. Even the roads and factories and buildings are considered capital because they're used to produce more goods and services. So financial capital so here we say one capital is this, another capital is called the human capital, the one you're learning here. So human capital, skills, experience, knowledge base are also capital. So it's a bit broader in how we look at an enterprise or the whole economy. Of course, land is anything natural, labor is anything human. It could be physical labor, like a FedEx person lifting weight, or it could be a brain surgeon who is doing complicated surgery, all are part of labor. Entrepreneurial ability is one of the resources that's the resource that combines all three and does what Lou was describing. So an entrepreneur would be the person who would know how to buy land paying rent, labor paying wages, capital paying interest, right? Interest could be although it is a debt interest, but we call capital, all form of payment to capital is interest. It could be a dividend, or it could be stockholders' dividend, or that's the way they get paid, the stockholders. Or it could be again other form of payment that capital gets. All right. So other thing that here, of course, remember that the profit taxation is an expense, but often taxation is imposed on the profit after the expenses are taken out. And the idea here is to make sure is that the economy, the way you grow, is making it available, making it easier for entrepreneurs to open new businesses. And tax would be another way of, we talk a lot about tax in terms of an incentive given to people to encourage them to participate in the economic activity. So an economist way of looking at things would be more sort of macro as opposed to the pure numbers. Although microeconomist looks at the competitive pressure, rivalry between two firms, strategic interactions. So there's a lot to talk about. I just
maybe it would be good to ask questions.
Answer a few of your questions that you may have.
Okay, you have questions. You can repeat your questions.
He actually answered most of them.
Great.
Yeah.
Well, you can say this. Say, Lauren.
Okay.
So, did you get your answers today?
Yes, I did. I don't know where I'm looking. Where's the...
It's just here. Look, yes, right here.
Oh, okay.
Yeah.
He answered all my questions that I had.
Dr. Fortunato.
Yes.
Yes, answer the questions. Very good. Yes. Barbara, you had some.
I did have a question, and it might be too detailed, but just out of curiosity for my own information. I don't know a lot about the stock market, and I know it's kind of a predictive sort of event. You know, people try to predict what will happen. And I was just kind of curious, what are the factors they really look at, say, other than a business plan, in order to make the predictions?
When you are an investor in the stock market, how do you decide which stock to buy?
Exactly.
Of course, the strengths of that company, their management strength, their business plan, their monthly statements, you look at some of the things are already public information. You are required by, if it is a publicly held corporation, then you are required by SEC to disclose some of your reports. You look at them, and then every company on their own, especially the ones that are established like GM or IBM, will put out quarterly reports for their investors to look at, and you should have access to them. You look at what they're doing, how much cash flow, and of course what the future look like. So you have to be very, very good at knowing where they will be, not today, but maybe 3-5 years down the line. And management strength, cash flow position, and of course their EPS. There are several numbers that you could look at: the earnings per share, return on equity, return on asset. Things like that are when you take the financial accounting course, they will talk about some numbers. The ratios, different ratios, debt to asset ratio, things like that gives you the strength of the company and their sustainability, how much they can sustain the economic downturn or a loss of their asset, or even some risk exposure that they may have. So based on all these, you have to decide. Ask Warren Buffett, who is a shrewd, very astute investor. He thought I look at the it has to make a ton of return on asset has to be quite high, and like Pepsi or Coca-Cola that he owns a lot, he says that its cost is very little, but it has a huge market, huge profitability, and he owns Norfolk Southern, a few other assets that are very profitable, and oftentimes he does it on his guts too. You have to be looking at many numbers. You get better at it. Although, are there courses? We don't offer any.
We have we've had an elective course called investments, and to supplement what you're saying is, if the corporation reports quarterly and they show a positive quarter, maybe above expectations. By the way, the companies, if they're responsible to the SEC, they will report 10Q reports, which are the quarters, 10K for the annual. But if they report positiveness, and remember, there's only a certain block of shares out there in the market, and the market responds positively and people start to buy, for anyone who wants to buy a stock, there's got to be someone who sells it. I mean, we just don't make new shares, all right, unless the company wants to introduce new shares. So the price starts to go up. Now that's out in the market. It's not going to affect these three items. This is within the company. It's the market. Now, if this company should report a very poor quarter, all right, people are going to start to low. The market is still going to start to come down. Still, you still have a block of shares. All right, so, you know, if the balance sheet is getting weaker, for instance, their current ratios, maybe under stress, which would mean how can we pay our current liabilities? We have enough in current assets. Maybe their debt ratio. A debt ratio is something very simple. Take all your assets, look at all your liabilities, what's the ratio? The higher the ratio, the more you owe. If you have a 90% debt ratio, that means you owe 90% on every dollar that you have in the balance sheet. Right? That happens to a lot of young people when they extend, right? And also, it did create issues with people now finding themselves underwater, they took mortgages, they couldn't have. The income statement is going to show revenue and expense, earnings per share. All right? In other words, for every share out there, what are the earnings? And stockholders like to see, they like to see that positively reported. You know, and CFOs and people who are chairs of the company, they're going to do everything they can to show a little movement up in that earnings per share. They don't want to show it down, and that's where that's where you get stress. You don't sleep because you're coming up, and then unfortunately things happen.